Welcome to It's the Economy. The third quarter or the October-December quarter of FY22 will see its GDP estimates getting announced by the NSO on Tuesday. A CNBC TV18 poll shows that the economy will have grown by 4.7% in that quarter. This comes over a 5.4% growth in the year-ago quarter. The quarter ago, that is Q2 of the year 2022, growth was 6.3%. Now, the Reserve Bank had estimated that the Q3 GDP growth, October-December growth, would be at 4.4%, but our poll is saying 4.7%. Now, assuming the economy grows at 4.7%, as our poll shows, the quarterly GDP will come to a little over 40 trillion rupees in real terms, okay? This is not nominal. Now, at 40 trillion rupees, the economy will be 11% bigger than it was in the third quarter of FY20, exactly the pre-COVID quarter. This gives a 3.5% compounded annual growth. Well, probably not still pre-COVID level of momentum. We are now joined by two economists, Abhishek Upadhyay, the senior economist at ICICI Securities, PD, and Indranil Pan, the chief economist at Yes Bank. Gentlemen, thank you very much indeed for joining me. Abhishek, let me start with you. 4.7% looks better than RBI's 4.4%, but I mean, why are we so far away from even the 6% handle?
Well, hi, Lata. So, 4.7% growth, I mean, is a slowdown, as you mentioned, compared to previous quarter. But if you are really looking at the quarter-on-quarter seasonally adjusted annualized growth, then it is a very, very strong number. So, don't be fooled by the weak headline. The quarterly growth momentum would be very strong in the high double-digit growth pace. So I think if this number is realized and we are expecting 4.6% growth in the third quarter, then that is a very, very good number. Also, if you look at the first advance estimate for the full year, which was 7%, then the growth implied for the second half of the year was around 4.5%. So this would be in the same ballpark. The big caveat, Lata, to all these forecasts is that this time around, NSO will also revise the growth numbers for the previous 3 fiscal years. And that would mean a very different quarterly growth profile also potentially in the earlier years. So the reference point that we have for 4.6% YOY growth for this year and the full year growth for 7% may be very different. Recall that in the earlier years, I mean, FY17, I recall the growth figure was upgraded by 1% compared to the first advance estimate. In the year FY20, pre-COVID year, growth figures were downgraded by more than 1 percentage point. So these revisions can tend to be very large. And if these revisions are again large this time, then these numbers that we are talking about could anyways be very different. So be mindful of...
Okay, one minute. Which are the numbers likely to be revised? FY22, last year's, the year ago quarter could be revised, you're saying?
Yeah, so FY22, you will get the first revised estimate. FY21, the second revised estimate, and FY20, the third revised estimate. So the full year numbers will change, the quarterly numbers will change. And if these revisions are large, then these numbers, the forecast that we are talking about, may also need to be different.
Oh, I wish I'd spoken to you before. I painfully made such a large Excel sheet. Now all that has to change. Okay, Indranil Pan, what is your estimate in terms of third quarter GDP growth? And are you also convinced that at 4.6, it should be considered a good number? You know, for an optical lay viewer, 4.6 looks like really bad.
Well, I think I have heard you as well as Abhishek. I think what is more important rather than the numbers is to look at the structure of the economy. Now, if you look at even the pre-COVID phase, the annual growth rate that turned out in that year was 3.7%. Now, irrespective of the revisions that Abhishek talked about, I think 3.7% when the economy was a normal, sort of fully operational economy, doesn't really talk well in terms of the structure of the Indian economy. Now, we had the COVID and we had certain deadweight losses out of the COVID. So what we see over the next few years is, or what we have seen over the last few years, has been a lot of adjustments in terms of the growth numbers, in terms of the YOY changes, and therefore we are normalizing towards the trend path growth, which is unfortunately, in my opinion, about a 5.5% at this point in time. So from that perspective, definitely 4.6% looks to be a relatively weaker number. But on the average, I think we are looking at a 6.8 to 6.9% for the current financial year, and that to dip to about 6.1 to 6.2% in the next financial year.
Okay. Abhishek, just once more, a lot of people, general newspapers, and even our own viewers will be asking us, isn't 4.6 or 4.7 bad? Give me an answer to them which will be understood by a layperson.
Lata, so what has happened is that in each of the last two fiscal years, growth was very back-ended because first the nationwide lockdown and then the Delta wave both hit in the first part of the year and impacted growth severely in the first part of the year. In the second half of the year, there was growth catch-up in each of the last two fiscal years. So the base effect is quite adverse, and that is what is the key reason why headline growth will be sub 5%. But again, the quarterly growth numbers, the QSA annualized growth numbers is something which all economists tend to watch to gauge the growth momentum, and that would be a reasonably good number. So I would be quite happy if these numbers are realized. It would add confidence to the growth forecast next year that we see in the 6% kind of a handle. Of course, we still see downside risk to those numbers compared to RBI, which is predicting higher numbers. But 6% growth, I mean, some growth slowdown you need to see next year for inflation pressures to cool down. So 6% may not be a too bad an outcome next year. So if these numbers are consistent with that forecast, then it's a good number.
Okay, got that. So there has been a very high base effect because both in the previous year and the year before. Last year, we were coming out of Delta, so Q3 was very strong. And the year before, we were coming out of the first wave lockdown. And therefore, the base also makes this 4.7 what it is. If you looked at quarter on quarter, I think it works out to about 5% almost if we generate about 40 trillion rupees. And that's a strong growth. Okay, within the components, Indranil Pan, is there anything that stands out for you in terms of good performance or dismal performance?
So obviously, so in the last quarter, we have seen a very sharp downside in terms of the manufacturing numbers. So some of the normalization will happen over there because commodity prices have actually tended to be lower in Q3 compared to the Q2, and that should continue even in the Q4. Services sector growth is likely holding up. So that's the positive side in terms of the growth trajectory that we look at. Unfortunately, I think from an overall numbers perspective, we may be sort of looking at slightly more cautiously in terms of the agriculture sector. Because to a certain extent, as we know that at least for the next year, there have been certain question marks that are getting raised on the monsoon. And even for the current year, I think there have been certain reports in terms of damage to the crops, standing wheat crops because of the relatively higher temperature in February. So for the Q3, to be very specific, I think we should see some normalization of the manufacturing number. And as I said, because of the input prices turning out to be relatively lower, mostly from the commodity perspective, and the services sector demand should be seen to be holding.
Okay. Abhishek, what would your sense be? Where would be the strengths and where would be the weaknesses? Can you train your eyes to what we should watch?
Well, yeah, so I tend to look at the non-farm, non-government spending kind of growth component to gauge the underlying demand. And while headline growth you're saying is weakening compared to the previous quarter, if you are comparing the non-farm, non-public administration defense services GVA component, that is going to be roughly flat if our estimates are broadly fine. So that is something to look at. In terms of details, I mean, it is likely that, as Indranil mentioned, manufacturing growth was very weak in the earlier quarter. Even though IIP manufacturing has been in the same ballpark around 1% growth, because the cost pressures, etc., might have been lower and input and profit margins would have increased. It is possible that industrial GVA contraction is not as bad as previous quarter.
Okay.
Also, the mining and electricity sector growth has been strong, but services sector is always the main focus. And on that, you should in the YY components, you should see some slowdown. But construction services particularly should see a pickup. Cement, steel consumption growth has been very strong over the last quarter. That broadly means that both the consumption and the capex side, high frequency indicators are holding up broadly in the third quarter, and that is broadly I would expect the takeaway from the GDP details also.
Okay. Anything we have to look at in the expenditure side, Indranil Pan, in terms of government final consumption expenditure, personal final consumption expenditure, gross fixed capital formation, what may be the surprises or the disappointments?
So in terms of the private final consumption expenditure, I think Q on Q for the first quarter was at a negative 2.4%, and for Q2 it was a positive 1%. But I don't think there is a very strong growth that is expected in terms of the private final consumption expenditure, given that the inflation had continued to be sticky, and even in the Q3. And to a large extent, we had been seeing increases in the interest rate. But definitely, I'm not, however, on the other hand, expecting a negative growth in terms of the private final consumption expenditure. In terms of the investment demand for the economy, obviously, the central government had been quite strong in terms of its expenditure, though the expenditures are expected to be picking up in the Q4. But private consumption, private investment expenditure was possibly quite weak. So in terms of the capital formation, I don't think we are likely to see a very strong number if you balance these two out.
Okay. Okay. All right. Very quickly, Abhishek, do you want to add anything on whether it will be an investment-led or a consumption-led growth? And briefly, if you can also say what you're expecting in April. We haven't spoken after the MPC minutes.
Well, so I don't think quarterly, I mean, on a quarterly basis, you can make a deduction that it's a capex-led growth or not. Broadly, yes, I mean, there are some tailwinds now. Some of the growth pessimism on the world demand side has eased down a bit. Also, domestically, government has revealed a strong capex growth number. So some optimism maybe on capex compared to what you were earlier seeing. Okay. But I don't think you can make any strong deductions about that from the quarterly numbers. On the minutes, minutes reveal that RBI is more or less data dependent now after steady rate hikes over the last year. But the worry is that data has not been, especially inflation numbers, if you see, are surprised higher. So we will still have one more round of inflation data. We'll have more US data. We'll have outcome from the Fed before we meet next. It's a 50-50 for us right now, is all we can say at this point.
Whether RBI will hike or not. Okay, fair enough. We will take that with both hands. As you say, there is our own inflation data that's due for February, and you will have US data. Thank you very much, Indranil and Abhishek, for preparing us for February 28th, Tuesday, when we will get the third quarter GDP numbers. Be prepared for a lot of previous year revisions. That's the big takeaway from our economists. Wrap up on Bazaar. On that note, we leave the market in green terrain. Chartbusters will take the action forward.